The equity result was also a strong result, the 21% for the year, made up of a 9% distribution, or 18 cents for every unit, and 12% in capital growth in the underlying shares. The composition of the fund at June 30, the 176 million of listed equities, fixed interest and term deposits and cash. You can see roughly 115 million shares or units on issue, and the unit price of $2.43 should quite neatly match up with the portfolio funds of $279 million. We do manage two accounts for two offshore investors that are approximately 20 million. Importantly, they are identical in composition to the growth fund, so we don't pick and choose or manage accounts separately for individual investors. It's not a broking organisation. Their difference is only structural in that their accounts are offshore. I'm not sure if you can see that in the back, but it's a long-term distribution chart, and I suppose what we are proud of is that we're able to deliver good, solid cash distribution with the capital growth that goes with that over a meaningful period of time. There are obviously some distorted years there which figure large realised capital gains. But on the whole, in a low interest rate environment, an investment in the equities business has generated for investors really nice, solid cash distribution. Plus, if we do our job reasonably well, we should be getting capital growth on top of that. It's no surprise that that's a feature of our business model, because it's exactly what we insist on from the companies that we invest in. So Greg Ellis would tell you that when we come and see him, how much cash are you going to be distributing? What are you going to be reinvesting into your business? How well are you going to be redeploying that is a constant question of ours. So what I might do now is just ask a Senior Portfolio Manager, Brad, to come and talk about the year that was.
Thanks, Barry. I guess I just want to start by reiterating a bit what Barry said. The concept of paying out a distribution and still having funds left over for future growth is something that we view extremely favourably within River. We call it investment nirvana, when a business can consistently pay out a handsome distribution or dividend and then still have funds to retain for future growth. In fact, this is a key characteristic which we look for when investing in businesses within the fund specifically. Another feature of our portfolio, and some of you have asked about this in the past, is our cash balance. We think this is pretty important for two reasons. First of all, it gives us the firepower when we need to act quickly. And often in the case in the small cap universe with which we operate, we need to make decisions within 1 or 2 days or within a week, and having the cash there ready to go is a significant advantage as we see it. The other key point to note here is we're not a fund which shorts or uses derivatives to sort of mitigate the risk of the portfolio. So in our view, the way we sort of control the risk and remain comfortable is via that cash position. And as you can see from some of these numbers up here, it really hasn't deteriorated at all from our performance. For 2013, obviously it was a decent year for us, and I've got up here on the slide some of our best performers. Ramsay Health, which some of you have heard us speak about in the past, it's a private hospital operator that generated the best return for us over the year. REA Group, which unfortunately Greg's just left to see how significant it was. And Fisher & Paykel Health was an interesting one. It's a New Zealand-based manufacturer of medical equipment. InvoCare, a funeral care operator here in Australia, which we've probably spoken about in the past as well. And Intercontinental Exchange is a US-based commodity futures exchange. The interesting thing here is, I guess we were sitting up here, it was last year, and talking about Fisher & Paykel and Intercontinental Exchange as being the two exciting opportunities that we thought would be big winners for us in 2013. They're both offshore based, and it provides a little bit of diversification in terms of currency for the big fund. We're asked the question quite a bit as to why we are different, and it's a tough one to answer, but we feel like we do a pretty good job of it. And unlike our peers, who sort of, we think everyone hits that top level okay, our investments in InvoCare, Consolidated Media and Fisher & Paykel, once we've invested in a business, our view is we don't stop there. It's like that next level we go to, and we'll go far and wide. we'll go across the globe, compare to peers and compare to competitors, and make sure that we've got the best of breed in that particular space or sector. And as you can see from this chart, there are three good ideas at the moment that we've got in Dignity, Sky TV and ResMed have been a result of our investments in InvoCare, Cons Media, which is now out of the fund, but it was bought out by News Corp, and Fisher & Paykel. This just shows sort of the next level that we go to and how we differentiate ourselves from our competitors. In terms of our outlook for the year ahead, the market, I guess, feels a little bit expensive right now. We've seen prices of some of these businesses trend up, and in some cases the profits have tended not to follow, or even in some businesses actually gone down. We think that this presents an opportunity for us, the guys who are willing to go wider and who are willing to go deeper than the next guy. We think it will present some opportunities to find those businesses with solid cash flows, and we can hopefully obtain them at reasonable prices. And they do exist, and we do have a few in the pipeline which we hope will deliver us similar returns for the upcoming year. And as we specified earlier, our big focus of our fund is to deliver a good distribution and still have funds for future capital growth beyond that, delivering a solid return for our investors, the same as we would demand from any company we invest in.
Thank you, Brad. Just on that last point, continue to pay a distribution. We talk about InvoCare for many years, a company that pays out all of its earnings and grows at 6, 7, 8, 9% a year. If you think about owning a property where the tenant pays the rent, there's not much money that needs to go back into maintaining the property, and the rent goes up at 7, 8, 9% a year. That's why we call it investment nirvana. It doesn't happen often. When it does, those companies tend to trade up to pretty high PE multiples, but they're there in the case of InvoCare for a reason. Long-term distribution and steady growth in that we get the cash and they continue to grow. It's a good model. It's a good model. I'm going to ask the guys to come up and answer some questions, but I just wanted to make this final point on the team. It's a messy slide. There's lots of boxes. And I'm not so much focused on the boxes or the names, but what it takes to sort of build a business that we're building and the depth of resources. There's a lot of people involved in the business that are not here in the back office. We call it the back office, probably should be called the front office, but that do an incredible job. You can't run a business like we do with the range of investors that we have and the systems that we require without a significant investment in a team. And as I said at the start, very proud of what we're developing in that regard. River Capital and the community. Sorry, I did want to say one other thing on the board. Roland Brown, who was with us, not here today, was, I think, one of the earliest River Capital directors, started with me in 1996. After 18 years, retired finally this year, and I think he's bike riding around Europe. But Roland had a tremendous impact on me. Was a terrific mentor, and we're busily searching for a replacement for Roland. Won't be easy to find a replacement, but someone with a similar set of skills. Just wanted to make a note of that for Roland. On the community, we do lots of wonderful work with the community. We actually use the River Capital office to host a couple of philanthropic organisations. One is the Smiling Mind. They've taken the space that the Inspire Foundation had in our office. Smiling Mind work on de-stressing and meditation programs for kids, for juniors, for adults. They do a good job with us. But it's a really nice paradox in a sense, where we're in this funds management business and we're all focused on returns and financial outcomes and all those sorts of things, and then we've got this nice balance in the office where people are focused on people. And as I say, I think it gives us, we get a lot more out of that relationship than they get from us. And it's very important. I appreciate everyone coming along. I know it's not necessarily the most convenient time. Really appreciate your attendance. And as always with River, feel free at any time to call any of us, come in for a meeting. We're pretty, as I say, we run it pretty informally. Happy to chat at any time about what we're doing. We think we keep it pretty simple, and really appreciate your attendance. Thank you.